Hello, everyone. Good evening and welcome to this outstanding event organized by Wheeler Institute for Business and Development at London Business School. My name is Sergei Guriev. I'm the Professor of Economics and Dean at London Business School. It's a great pleasure to welcome today Pierre-Olivier Gourinchas, the Chief Economist of the International Monetary Fund, who is going to talk about the issue or the set of issues that everybody is asking economists today. As an economist who is not working on those issues, I can confirm whenever you say I'm a professor of economics, people are asking about geopolitical tensions, tariffs, and the world economic outlook. Now, we have the best person to talk about it today because IMF is actually the institution which publishes World Economic Outlook twice a year, and sometimes actually does updates more often than twice a year, which is very welcome in this very uncertain and dynamic, let's put it this way, dynamic macroeconomic environment. And we're very excited to have Pierre-Olivier to talk about this, not just because he is the person who leads this work as a chief economist of the IMF. He oversees all the research IMF is doing, but also he is an outstanding macroeconomist himself, has published important work on international macroeconomics. Pierre-Olivier is now on leave since 2022, so interesting year to come into this job. Since 2022, Pierre-Olivier has been chief economist of the International Monetary Fund, been on leave from University of California at Berkeley, where he's a professor at both economics department and the business school. As many French economists, Pierre-Olivier graduated from École Polytechnique, then did PhD at MIT and was on faculty before Berkeley on faculty of Stanford and Princeton. He has a distinguished career, not just in academia, but also in policymaking. Before coming to the IMF, he spent a year in the French Prime Minister's Council of Economic Advisors. That was 2012, 2013. Of course, what is very important for every French economist, he's got a Young Economist Prize by Cercle des Economistes and Le Monde. And this actually is very hard to get, which actually shows you are the best economist of your generation. It's an annual prize, so many French economists actually have received that, but it's still a very prestigious award, and every French economist can list all the top economists who have received this award by heart. So without further ado, I suggest we give the floor to Pierre-Olivier, who is going to talk for about 20 minutes, and then we'll invite Hélène Rey, Lord Bagri, Professor of Economics at LBS, to moderate the discussion, questions, and answers. Pierre-Olivier, the floor is yours. Thank you very much.
Thank you, Sergei, and thank you very much for this very kind introduction. So I will be giving a quick presentation based on the World Economic Outlook report that we just published at the end of last month. And as you can imagine, this has been an unusually busy period for us. It usually takes us about 2 months to put together our round of forecast for our report. And we start almost as soon as the previous report is issued, which in this case was the end of January. So we start at the end of January, February, March. By the end of March, we're ready to go. Everything's in the can. April 2nd comes around. So we take everything we've done, throw it out the window, and what we do in 2 months, we did in 10 days. And then April 9 came around. And so at that point, we thought, no way, we can't just adjust that quickly. And so what I'll show you is also a sense of how we approach that question of how to assess the state of the global economy when there is so much uncertainty about the trade policy environment. Obviously, everyone has been talking about this. Most recent developments just announced yesterday, but also of policy uncertainty more generally. And I will start by saying that the first observation here is that there's a sense that we share that the rules under which we have been operating for the last 80 years, since pretty much the end of the Second World War and the creation of the Bretton Woods institution, and the global institutions, the IMF is one of them, the World Bank, later on the WTO, is being reset in a very profound way, and we're potentially only at the beginning. And there is probably a sense in which we're not going back to what was in place before. And at the same time, there's a sense in which some of these changes have been in the making for some time now. So this is not just a random event. This is a culmination of pressures that have been building in the global economy for some time, and I'll come to that. So my first slide here is to illustrate this importance of uncertainty in shaping the outlook, and what I'm showing you here on the left is a measure of geopolitical risk that you can construct and track over time, and you see that this is quite elevated. The middle chart is showing you measures of trade policy uncertainty together with a more traditional measure of risk, the VIX index, and you see how this has spiked in the last month. It's been coming down since then some, but this has been reaching very elevated levels that we hadn't seen more or less since the COVID pandemic. And the third picture is showing you that what we already know, which is that elevated uncertainty is typically a significant drag on activity, and when you look at the estimates of the impact of rising uncertainty on global output, it's negative and quite significant. Now, of course, trade is the focus here, and we are going through a big trade reset. No one can really say where it's going to end, but we're in the middle of it. One way of looking at it on the left is a graph that many of you have seen, I'm sure, in some form or another. We're not the only ones to have calculated something like this, but it's a measure of the effective tariff rate that the US is putting on the rest of the world. Over time, you see that this was, of course, quite elevated in the late 19th century, and then it started coming down, came up again during the Great Depression, the time of the Smoot-Hawley tariffs, and then in that post-war period, we had a sequence of trade deals and increase in multilateralism and negotiations that led to a decline in the effective tariff rate that the US put on the rest of the world, up until you see this little bump there in the black line towards the end. That's the first trade war between the US and China in 2018, 2019. That was relatively small, even though it got a lot of attention at the time. And then you have three diamonds on that chart. The blue one is where we were at the end of March, when tariffs had been announced on Canada and Mexico, on steel and aluminum, on cars. The red diamond is when we were on April 4th. So after the Rose Garden announcement, where the US administration imposed tariffs on most countries and small islands in the world. And the green diamond is where we were as of April 9. In other words, after what is called the pause, when the US reduced the tariff on most countries to 10%, but increased them on China to about 145%, and China is such an important trade partner that when you measure the effective tariff rate between the US and the rest of the world, in fact, under the pause, that effective tariff rate increased, if anything, to a level that we haven't seen since pretty much the beginning of the 20th century. Now, with the most recent announcements, some carves out have happened since then on electronics, a deal with the UK, the announcement of a new pause with China. That effective tariff rate is probably, according to our calculations as of this morning, is probably around 14.5%. So it's come down from these very elevated levels, but it's certainly not come down to where it was even at the end of March, and effective tariffs remain very elevated. Now, this is not just the tariffs of the US on the rest of the world. A number of countries have taken measures also to increase their tariffs on the US. So you see that on the right, the tariffs on US exports have also increased, and the tariffs on the world as a whole have been fairly elevated. So that's the background. Now, in terms of how this is affecting the global economy, the first thing before we get to what we can anticipate looking ahead is what happened in recent months, in particular towards the end of last year and the first quarter of this year. We've seen a lot of front loading. We've seen a lot of front loading in anticipation of the tariffs being imposed, but the tariffs not being quite there yet. And so you see this on the left, you see it on US imports have been surging. Actually, those numbers going all the way up until February 25. Didn't update them with the March numbers. The March numbers are out now, and there's an even bigger increase in imports from the rest of the world in March, again, in anticipation of tariffs that are about to come. Forget about the yellow line. This is a little bit of a bizarre thing going on with gold bullion imports. But even without that, you have a surge in imports. And in March, actually, even though the bar is not there, a lot of this was in pharmaceuticals coming from Europe. The other thing we know happened in earlier episodes, and we see again this time, is that in anticipation of tariffs, there is some front loading in consumption. The graph on the right is showing you that consumption has actually been surging ahead of the imposition of tariff, just like we saw in 2018, 2019, and decreasing, expected to decrease or starting to decrease after the beginning of the imposition of tariff here, which comes after January 20 of this year. So that's what is already in the data. What about inflation? Well, I'm going to develop that a little bit more in a few minutes. But when we're looking at inflation, the situation, the starting point here is one where our assessment was that the big inflation surge and decline was mostly behind us. We had a huge increase in inflation, most of it related to the combination of supply constraints and a push in demand coming from fiscal and monetary support in many advanced economies. And in addition to that, the increase in energy prices related to Russia's invasion of Ukraine that push up energy and some food prices. The combination of all these things led to the largest increase in inflation we've seen in 40 years. Central banks got in on the action, maybe a bit late, maybe not, started raising interest rates. Inflation started coming down, and by the end of last year, inflation was largely a rear-view phenomenon. We were expecting central banks' inflation to be back near central bank targets, and basically from that point onwards, inflation drivers to be coming from new shocks. Well, there are some new shocks. The new shocks are coming in the form of trade policy. And so here, what I'm showing you on the left is, for instance, you already see in some high-frequency indicators that US manufacturing firms are reporting already price pressures. And when they're asked about where this uptick in prices is coming from, about a third of them are reporting tariffs as one of the reasons why they anticipate the price of their inputs to be going up. When you're looking not just at the US, you're looking at G20 countries, that's the middle graph, you see that the inflation rate on goods, that's the blue line, which had been coming down very fast and had been a big factor behind the disinflation process. The reason inflation has been going down is mostly because inflation on goods has been coming down very fast and stayed below historical averages, that's the dashed line, while inflation on services remained somewhat elevated. It's really the goods story that's been bringing down inflation, where we see a reversal in that. So goods inflation is picking up, while services inflation is not coming down that much. So overall, there is a potential for inflation pressures in some countries to increase again. On the right, you see that when you look at emerging markets, even though the overall story was one where countries were coming back down to central bank targets, that's not uniform. And actually in emerging market economies, in particular in Latin America, if you look at countries like Brazil, you look at countries like Mexico, you had inflation pressures building up already. This is showing you the fraction of countries that are overshooting their inflation target, and you see that in emerging markets that was actually rising. So we're in an environment in which inflation was largely behind us, but there were some fragilities, and one of the fragilities I'll come back to is also in terms of inflation expectations. Inflation expectations remain very well anchored for most of this inflation surge and decline. Medium-term inflation expectations, the 1 year kind of tracks and looks backwards, so the 1 year kind of tracks inflation. The 5 year out remain very, very stable. But that's mostly because people believed that central banks could deliver stable prices, and they had never seen inflation like that in 40 years. This time around, if we get some inflation surge, the worry is that people, businesses, households, workers are going to be much quicker in translating what they see or the fears they have about where inflation is going into higher inflation expectations, higher negotiations for wage increases, higher bargaining on price increases. So there could be a de-anchoring of inflation expectations this time around. We didn't have that last time. On currencies, I'm going to split this chart into two periods. I'm going to look at what happened between the US presidential elections back in November and the inauguration, and then from inauguration to almost now, I think where we stop here is April 16th, so almost a month out, okay, on this chart. And what we saw during the first period, November to January, was a huge appreciation of the dollar across the board. Now, what this chart does on the left is it decomposes this using a VAR into different drivers. And you can see is the expectation was that you had a stronger currency. Why? Well, because you had expectation of good news on the US economy. All the rage 6 months ago was about US exceptionalism, about productivity growth in the US, how US was growing, the rest of the world was not. There's truth to that story, and that was also something that was fueling increased growth or expectations of growth in the US. Associated with that, the view that if there was a strong growth, maybe the Fed would not be able to ease interest rates as quickly, would have to keep interest rates higher. So you see the monetary policy component also in expectation leading to strength in the dollar, and relatively little in terms of global risk. Picture completely changes after inauguration, where there is a significant revision in growth prospects, associated with that revisions in what the path for monetary policy is going to be by the Federal Reserve, and a big increase in global risk, which traditionally, but I'll come back to that, tends to support the dollar, but certainly was not enough this time around. The graph on the figure on the right is showing you that this maps very well with what we saw in capital flows to emerging market economies, but I'm going to skip that in the interest of time. And someone, Hélène or Sergei, please tell me when I'm running out of time. So that is consumption, prices, exchange rates. What about labor markets? Well, labor markets are kind of the good story when you look at where the global economy was. In most countries, we've seen a slight uptick in unemployment rates since the trough. We had very, very low unemployment rates in many countries by historical standards towards about the middle of last year or beginning of last year. Unemployment rates have been inching upwards a little bit. That's what you see with the black line here on, I don't know if this is working, the black line on the left, but not very different from the increase in unemployment you see when the economy is coming from a trough in unemployment rate, but is not going into a recession. That's the red dashed line. The blue dashed line is showing you what happens when you go from a trough to a recession. You have a much sharper rise in unemployment. We're not seeing that right now. So labor markets, this is not just the US, this is average over advanced economies. Labor markets are in a very good position. We have had some easing of the labor market tightness, very strong labor market tightness in many countries. That's not as tight right now, but really nothing that would be ringing alarm bells. Lots of job creation in services, less so in manufacturing. We kind of know that. And that's sort of the undertext for a lot of the policies that are implementing right now in many advanced economies to try to revive manufacturing. So this is why I have this graph on the right here, which shows you the share of manufacturing in employment. These are the blue lines for, the solid one is for the US, the dash one is for Germany. So if you look at the blue lines, what you see is that the share of manufacturing in employment has been decreasing for both countries, but it's been going on for a very long time. Here I'm starting in 1965. It's pretty much a downward trend. If you try to spot where you have China's entry in the WTO on this figure, or when the US joined NAFTA or renegotiated NAFTA, or when the EU was formed with a single market, you won't see them. This trend has been coming down. The second thing I want to point out on this graph is the black lines. The black lines is the share of output represented by manufacturing. Now, the important thing when you calculate this share, it's a real share. It's not a nominal share. Why was it important? Well, because the price of manufacturing goods has been coming down. So when you look at the nominal share, it looks like it's coming down. And so you might look at this and say, oh, look, we're producing less manufacturing. No, we're not producing less manufacturing. We're producing as much manufacturing. It's just that manufacturing is cheaper. Now, why is manufacturing cheaper? Manufacturing is cheaper because we know how to make manufacturing better. That's called productivity growth. And productivity growth shows up in the fact that you produce the same stuff with fewer workers. So this decline in manufacturing employment is a reflection of structural transformation from agriculture to manufacturing to services that's been going on for decades and is not directly related to trade. Okay, so this was kind of setting the stage. What can we anticipate looking ahead? What's the outlook? Well, as I told you, the difficulty for us when we were making our round of projection is typically we take policies, announced policies, not things that are just mentioned in one interview or in the press, but announced policies are enacted that are either voted by Congress or executive order or part of the set of policies that are official, and then based on that we make our projections. Well, the problem is how do you do that when the policies are changing from day to day and you don't know if they're going to be in place 3 months from now. So as I told you, we had a set of projections as of the end of March. That's the middle bar in the figure on the left. And what we were saying at that time was some slight reduction in growth from 3.3% that we estimated back in January to about 3.2%. So modest, very modest slowdown. Now, the other two bars flanking it on the left and right are what we are projecting based on the April 2nd trade policy announcements. That's the one on the left. Assuming that every country is hit by tariffs, the so-called reciprocal tariffs. And the one on the right is what happens under the pause scenario where everyone gets 10% and China gets a prohibitive tariff. First lesson, the global outlook is not very different under these two scenarios. It's about 2.8% instead of 3.2, so significant slowdown, but it doesn't change very much. Now, of course, the distribution is different. Who is going to be hit, and I'm going to get to that in a minute, but the overall outlook is very similar. Now, when we look at the decomposition of growth and inflation, this is on the left, on the right chart. Growth is down for every region. That's under our April 2nd scenario, which is going to be our sort of reference forecast here. And for inflation, the story is a little bit more nuanced. For inflation, you see that some countries are seeing inflation going up, some countries are seeing inflation going down. So let me unpack how we're thinking about the impact of tariffs on activity and inflation. So I have this sort of putting my former professor hat here. I have a little analytical slide, no graph on this, but just a few of the channels. So what I call the incidence is what we all know and think of when we think about tariffs. For the country that puts the tariff in place, it's basically raising the cost of intermediate inputs, it's raising the cost of foreign goods, it's going to reduce output and increase prices. The way we describe this is a negative supply shock. Negative supply shock is bad news. It's bad news because it's reducing your activity, but it's also raising your inflation. And that's the top line. What does it do on the rest of the world? Well, on the rest of the world, it's reducing the demand for the products that the rest of the world is producing and selling to the country that puts the tariff in place. So it's a negative demand shock. It's reducing activity. It's reducing price pressures. What is the impact on the dollar of that standard textbook level analysis? Well, it should be an appreciation of the dollar. Now, a couple of different ways to think about this. One is that if there's a demand shock in the rest of the world is going to cut interest rates. If there's a supply shock and more inflation in the US, let's say the US is not going to cut interest rates, and as a result, exchange rate is going to adjust that way. You can think about it in different ways, but it always leads you to the same conclusion. Now, there are a number of other rows here. Why is that? Well, because in this particular environment, we have a number of other layers. The second one is the one that a lot of people have talked about. It's the role of supply chains. We have very complicated supply chains, intermediate inputs crossing in and out of countries. And so these supply chains could be very severely disrupted by the tariffs. What does that mean? Well, it means another supply shock on top of the direct standard one, if you want, a bigger supply shock, negative supply shock for the US, but also a negative supply shock for other countries. If some of you have read what Isabel Schnabel wrote a few days ago about the ECB. She's concerned about maybe inflation pressures rising in the euro area. Why is she concerned about that? Well, she mentions explicitly the fact that there could be disruptions in supply chains and that, among other things, could be leading to a renewed price pressures. Impact on the dollar from this, not quite clear. The third row is uncertainty. I mentioned that we have an environment of very elevated uncertainty. Now, uncertainty means you postpone investment, you postpone consumption. You just want to, if you're a household, you're not sure whether you're going to have your job next period. Maybe it's not a time to go and buy a new house. Maybe it's not a time to buy a big ticket item. If you're a firm, you postpone investment. You're not exactly sure where to invest, how much to invest, who to source from, because they could be slapped with tariffs. So you don't know, you just wait. That is a negative demand shock for everyone. If it's a bigger negative demand shock for the US than the rest of the world, the reason here being that the US tariffs everyone while everyone else is only being tariffed by the US, then that would be negative for the US dollar. Now, the last row is if you think that we're getting financial volatility, markets are going to be nervous, the standard analysis is that this is also going to weigh on demand, but now there's going to be a safe haven role for the dollar. You're going to see flows into the dollar. That's going to lead to a dollar appreciation. That's what a lot of people were expecting when markets started to get very nervous at the beginning of April. What we saw instead was a depreciation of the dollar. Now, what I'm going to argue is not the only one, but a lot of people looked at this and said, well, something different happened this time. And that something different is related to the policy uncertainty, not just trade, but other dimensions, that led, in particular, foreign investors to reassess how much they wanted to be exposed to dollar assets. So what we saw is a shift in portfolio demand for dollar assets away from the dollar back to other things, whether it's the German bonds, the Swiss franc, or Swiss bonds, and other types of assets that led to equities coming down, bond prices coming down, and the dollar to depreciate. Okay? That's the last one. So we have a combination of all these things at the same time. Okay? And notice how the effect on inflation is going to be differentiated based on whether you're going to have the supply shocks that dominate versus the demand shocks that are dominating. Now, when we look at the decomposition by region, what we find is very much in line with what we are expecting from that simple analysis. So we asked our desk, who are providing us with the projection, we told them, look, for China and for the US, China is on the right, the US is on the left, give us the decomposition of your revision to growth and inflation that's coming from what you think is a tariff, the effect of uncertainty, the effect of fiscal policy, because some of these regions have implemented changes in fiscal policy also, and whatever else. And what do you see? Well, you see, look at the US. You see the effect of the tariff. The tariff is the sort of orange bar weighing down on output, weighing up on inflation. So that's a negative supply shock. The uncertainty part is kind of weighing down on output as well, not having much of an effect on inflation. You look at China, what do you see? Well, you see that the tariffs are actually weighing down on activity and on inflation. In fact, the impact of tariffs on China, these are the April 2nd tariffs of 54%, is very large, negative 1.3% on China. Now, our revision overall for China is only 0.6. Why is that? Well, because there is a fiscal stimulus, and there are other things going on with the Chinese economy that sort of bring some buoyancy there. The impact on prices is more price deflation. China is flirting with price deflation here, and we get even more of that. One other thing we can anticipate to see in the current environment, depending on the configuration of tariffs that ultimately prevails, is a lot of trade diversion. Why? Well, because countries are going to be faced with very different tariff levels, so there's going to be scope for rerouting trade flows to arbitrage the trade costs. Now, we saw that the left is showing you the differences in tariff rates under the April 2nd and April 9. The middle graph is showing you the trade diversion we saw, and something that we did a lot of work on following the 2018-2019 China-US trade war. What you see there is a huge decline in the bilateral trade between the US and China. But this is more than offset by increases in imports from other countries. And in fact, in our work, what we documented is the extent to which some of this was a rerouting of trade flows through connector countries, countries like Mexico or Vietnam or others, that basically received foreign direct investment, started processing goods and shipping them to the US, and therefore picking up the slack, if you want to know. That meant the global economy remained relatively well integrated, but the extent to which you can have that trade rerouting is actually open to question in the new configuration of tariffs that we're having now. And to illustrate that on the right, what we did in that chart on the right is we used our model and we said, okay, let's imagine that indeed the US wants to close all the bilateral trade deficits. Let's take that as a given. And suppose they succeed, which in practice means something very close to trade autarky. There is very little you can do in terms of closing all of the bilateral trade deficits with every country in the world, short of going to trade autarky. And if you go to trade autarky, let's ask what are the welfare costs of that? And so that's a scenario where the US is going its own way, the rest of the world remains integrated, and not surprisingly, what you see, these are the green diamonds there, the loss of output for the US is very large. It's also very large for countries that are very closely integrated with the US, Canada and Mexico in the first place. The impact on the rest of the world is not good, but it's much, much smaller, in order of 1 to 5. Okay, so now the next thing I want to show is, well, if we're thinking about the state of the global economy, and we know that countries are concerned about running large deficits, and maybe we don't want to think about bilateral deficit, maybe we want to think about overall deficits, and if tariffs are not going to be the solution, then what can be done? And in this topic of what we call global imbalance is certainly something that we've spent a lot of time thinking about at the fund. It's a core issue for us to make sure that somehow countries are not running excessive surpluses or deficits. And what we did is we looked at, and I want to emphasize the middle chart and the one on the right. We ask ourselves, what is the right configuration of policies that would, A, stimulate growth, and B, also help to close some of these large current account deficits for the US, large current account surplus for China. Now, mind you, China doesn't have a huge current account surplus. It's only about 2+ % of its own GDP. The issue is that China is so large that a current account surplus of 2% of its GDP now is as big as a current account relative to the world economy, is as big as a current account surplus of 9% back at the time of the global financial crisis, because China has grown so much. Okay? So what you have here is we are thinking, what are the right policies? The right policies are, we came up with, because we think hard about them, they're super hard to imagine. One is, well, maybe China needs to rebalance some of domestic demand towards, some of the demand towards domestic demand, supporting domestic consumption and domestic investment, and relying less on the export sector. China is a country with a huge saving rate. It is very weak domestic consumption, so policy that would redirect demand towards domestic drivers would help. Countries like the EU would benefit from having policies that would improve public investment, public R&D, boosting productivity and growth, helping absorb some of the large savings that it has. The EU is also a region with large savings. And for the US, well, for the US, it requires reducing its large fiscal deficits. The US is running large fiscal deficits, and they contribute to some of the external deficits that the country has. If you do these three things together, we put them in a model, and you get higher growth. That's the set of bars on the right here, higher growth for the world economy, higher growth in most regions, and more importantly, you get to significantly close these external imbalances, these global imbalances. So our view is the solution to the external imbalances problem is by setting the right macro policies, not by setting trade policies. Now, unpacking this a little bit further, and tell me how much more time I have.
I'm talking about 20 minutes.
Okay, so I'm going to wrap it up very, very quickly. Just a few things I want to mention in terms of monetary policy, in terms of fiscal policy as well, and I'll skip a few other things. So, monetary policy, I've already mentioned the fact that inflation expectations could be a little bit less stable this time around. In fact, if you look at household inflation expectations in the US, something a little bit worrying is going on. Now, maybe it's measurement, maybe it's we shouldn't put too much trust in this, but it was fairly stable, and those are the 5-year ahead inflation expectations. They've been increasing quite sharply to above 4.5%. So one would have to be concerned about that. This is not necessarily what the markets expect. The markets has a more sanguine view of what inflation should be when you look at break-evens. And the bottom line here, when we're looking overall at monetary policy, is that because it's going to play out differently, pushing up inflation pressures in countries that put tariffs on, maybe pushing them down in other countries, monetary policy will become more differentiated. We're not going to be in a one-size-fits-all. We're not going to be in a common hiking cycle or anything like that. When looking at exchange rates, I'm not going to dwell on this too much, but I'm just going to point out that I mentioned already that the dollar has depreciated rather than appreciated. In fact, if you compare to past historical episodes, this top band here is where you would have expected the RMB to be in terms of pass-through of the tariff to the dollar RMB exchange rate. We're very far from that at this point. Maybe we'll get there, maybe not, who knows. Currency markets have shown relatively little stress right now. They certainly haven't faced any kind of pressure that you see in previous episodes, in part because the dollar has not appreciated. I mean, the basic point for fiscal policy, and we can address this in the discussion, is we've seen in the last 10 years, we've seen an uptick in government spending. We haven't seen a comparable uptick in government revenues. Okay? Now, some of this has been eroded because we had a period of inflation. That certainly helped. That has brought down debt to GDP levels. But when we look past this, the picture is actually kind of worrisome. We are seeing increasing debt to GDP through the forecast horizon for a lot of countries in the world. So clearly, something needs to be done to bring public debt more into a sustainable basis. Now, it's not just because we're the IMF, and that's what we always say. The reason I'm kind of saying this is, I think in terms of my own historical record, I'm not exactly someone who you could call an Austerian, but I think there are times when you need to do it. And this is one of those times when we have to be careful. Why do we need to be careful? Well, because we live in a world in which there are big shocks. We live in a world in which there are demands on public support that need to be coming when there is a big shock that is realized. If you have the fiscal buffers to do that, then you do much better. The evidence of the COVID period is that those countries that did more were able to come out faster, stronger, and recover lost ground much, much quicker. The ones that were not able to do that, that's a lot of emerging markets, that's even more low-income countries, they're still below the pre-pandemic trend. They haven't recovered even to the pre-pandemic trend. Other countries like the US have been above. You won't have that capacity to be able to do that. If you don't have it when the shock hits, you have to adjust the hard way. So those fiscal buffers need to be rebuilt. Now, the difficulty is we're in an environment in which there are additional demands on spending. European countries, there is a need to address the need for economic security and the need for national security. So defense spending is going up. There are all kinds of other demands. So how can you square the circle here? Well, you have to do it in a way that is gradual. You have to do it in a way that doesn't kill growth, but you have to do it, and you have to do it in a way that is, sets expectations and you deliver on those expectations. And on these three metrics, I think the record has been relatively poor up till now. And so there is a need to be much more vigilant on how much risks are being taken on the fiscal side, because the room there is getting relatively short. And since I don't have my fiscal side, I'm going to stop here and open to discussion with Hélène. Thank you.
Well, thank you very much, Pierre-Olivier, for this very broad-ranging and fantastic presentation. I think we could all see that he's not only an economic counselor, but you could see the professor in there. You could see the wonderful scholar also who has worked a lot on global imbalances and has made very many deep contribution to our thinking of how the macroeconomy works. And I would just like to start by prolonging a little bit what you said about tariffs, because you have also done some work, as you mentioned, about the fragmentation of the world economy and how the pattern of trade is affected by tariff. So in particular, as you mentioned, in the last set of tariffs of the Trump administration, we have seen a reconfiguration of supply chains and these connector countries through which a lot of trade was being rerouted. So that, in fact, if we looked at aggregate trade data, we didn't really see that much of a decline in trade, and that was kind of surprising. But do you think that this set of tariffs which, there's so much uncertainty around them, and they are changing all the time, and we don't exactly know the horizon. But do you think this set of tariffs is going to lead similarly to a rerouting of supply chain, or that this time around we are really in for a deep fragmentation of the world economy, both in terms of goods trade, but also in terms of investment flows, in terms of capital flows, in terms of any kind of interaction, really technological diffusion across countries? And if this is the route which we are taking, which I don't know, I think it's, you'll tell us what you think, but so what does the IMF do in such a world? I mean, in terms of also, thinking about international financial stability on a multilateral basis, etc. So if you had thoughts on this.
Well, that's a core question, and so just to take it from the top, it's certainly the case that trade to GDP, which is one way in which we can assess the extent of economic integration, was on a tear from late 1990s up till the global financial crisis, and then it kind of plateaued. It hasn't come down, but it kind of plateaued. It came down very briefly during COVID. It came down during the global financial crisis, but then it bounced right back up. During COVID, it's kind of understandable. You couldn't ship things. Everything was shut down. But it bounced back up very quickly. And so trade to GDP remained fairly constant, despite the fact, as you pointed out, that we've had some of these rising trade tensions. And by the way, it's not just the US and China. When we look at trade distorting measures, and we have a global trade alert that is kind of tracking all of this, we're seeing in 2024, it was about 3,000 new trade distorting measures. That's up, 3 times from 2019, and 2019 is up, 5 times from 2010. So we've seen an explosion in trade measures, not just China and the US. Despite this, trade has remained fairly stable because we have seen a lot of this rerouting. We've seen the rerouting in trade. We've seen the rerouting in FDI. I mean, FDI and financial flows have actually been declining a bit since the global financial crisis, not as high, especially other types of flows. Maybe FDI is maybe less so than other types of flows. So should we expect the same going on? In our round of projection, we try also to get a sense of where world trade is going. Mm-hmm. And here we're seeing something that is different this time. Again, under the April 2nd tariff assumptions. And whether we're still in that world or not is I think, up for debate. But under the April 2nd set of tariff assumptions, what we are projecting is a decline in trade relative to GDP. So trade would still grow, but at only about 1.7%. World GDP would grow at about 2.8%. Trade to GDP would start declining, but more importantly, would continue declining through our projection horizon, so 5-year out. So unlike the previous episodes where maybe it comes down and it bounces back up, this time we're expecting a decline. Now, what's maybe making the picture a little bit more complicated right now is we're seeing an enormous amount of front loading. I've showed you the imports into the US in Q1. We're seeing a lot of front loading. We're seeing the overall exports from China are also decreasing going from China to the US, but they're increasing going to other countries. That could be actually some of the indirect effect of earlier front loading to the US. So all of this the picture is very complicated right now, but when we look through the noise, we're anticipating that the kind of effective tariff rate we are seeing right now is not something that is as easily avoidable by rerouting and connector countries. So we're projecting that it could have a damaging impact on trade. So of course, from our vantage point, what we think is really important is to address the uncertainty about trade policy. That somehow businesses and economies need clear, transparent rules for thinking about investment when it comes to trade, FDI, etc. So having, open, clear, rules-based trading system is certainly what we would call for. What we are likely to see, if I sort of put on a more positive hat than a normative hat, is we're likely to see increased efforts at regional integration. I think the fact that we have these tensions between the US and other countries, including China, can lead to renewed efforts for other regions of the world to integrate more together. there is enormous potential there. I mean, if you think about African countries, for instance, typical African country does more trade with the US or the EU or China than it does with the country next door. So there is tremendous potential for trade integration at a regional level. We've seen efforts to go in the direction for other regions of the world. There is the Mercosur agreement that is being negotiated and is going for approval. There are various trade deals that are happening. So I think all of this paints a picture of where we're going to have more regional trade deepening, and some of it will offset some of the losses. Whether that's enough to completely compensate, we're not so sure. And
on the FDI side, you expect as well that it's going to go down quite a bit?
On the FDI side, I mean, it's yes, for similar reasons, which is that, once you do FDI, you have to be pretty sure about access to market, about the environment in which you're operating. So certainly on the FDI side, we would expect to see some significant impact.
Thanks a lot. So another issue that you started to touch upon was the market reaction, right, to the April 2 announcement. And that was a very unusual reaction, as you pointed out, because usually in bad times, what we see is indeed the dollar, safe asset, reserve currency, dollar appreciation. And to the shock of a lot of people, I guess, this time around, it didn't happen. It was the typical emerging market kind of co-movements in terms of equity prices down, yields in the US up, and dollar down, which is very, very unusual. At the same time, if we look at the reaction of the markets like today, and also in a way the way things are still priced in the market, one wonder if the markets are not still betting on trade negotiation being successful and discounting the possibility of a seriously segmented world that we of a type that we just discussed. It seems like maybe there's still a lot of optimism in the valuations of the market. So I'm not exactly sure how to square these two observations. On the one hand, this very kind of unusual market reaction and the dollar going depreciation, at the same time this kind of prices in the market, but maybe still quite high if we are really in a very, very bad situation. So is there one which is just a reaction and then a lot of volatility and that's a temporary thing, but the market being still optimistic, or what are the markets thinking?
Well, I'm not sure I know what the market is thinking, but I think that certainly the market has been. We've had periods where the market can get optimistic about the outlook or pessimistic about the outlook, and so I don't think that necessarily the dust has settled. But let me come back to the first part that you raised about the market reaction at the time of the tariff announcement and the unusual configuration with, in particular, the dollar response. And so here, I think, as I try to argue, I think one way to think about this, which is useful for me when I'm trying to sort of process the information we have, is to think of this as I said, as a negative portfolio demand shock. Now, what's important to realize also is, and I had a chart on this which showed you that we had this super strong dollar appreciation and also increase in equity valuations from November to January. Markets improved tremendously. The dollar was very, very strong. Bond markets were, in fact, the bond yields were not decreasing over that period, but mostly because they were expecting that there would be more tightening by the Federal Reserve. So it was pricing basically higher future policy rates by the Fed. So there was a very bullish view of the US economy. And so what we've seen is a bit of a retrenchment from that and a reassessment of the overall likelihood of some of these scenarios. Now you're right to point out that since then, the markets, as the news have been coming along, that there would be carve-outs, there would be maybe pauses, that would be extended, the tariff rates would not apply. The markets have seemed to have come back and concluded that maybe none of this matters very much. Our view, reflected in our projections, is that there is an impact on activity. There will be an impact on activity. There will be an impact on prices. There will be responses that will be adjusted by central banks, and so all of this will be reflected in the real economy, and I would expect that the valuations will reflect that eventually.
So if I may push a little bit more, in terms of what we see in the international financial system. So at the same time, so we don't exactly know if it's a persistent shock, this dollar reaction, if it was purely because there was so much overweight indeed of dollars in portfolios, whether this is a lack of trust somehow in the dollar, which is going to be here to stay for a while or not? So I think it's a very big question for a lot of people. And also this comes at a time where we have a lot of new types of currencies and gold flows, cryptocurrency flows, which become more important in the international financial system. And so is this something, so how do we think about that? And from the IMF point of view, so do we think about these type of new crypto assets as alternative currencies? Do we think they are going to be, or they could potentially be an issue for the conduct of monetary policies, for stabilization policies? Do we see them as alternative capital flows that may be a little bit under the radar and also maybe an issue for the fiscal side of things, and maybe keeping track of what's going through offshore tax haven? Is it something that the IMF is thinking about? Are there data? I mean, what from a policy point of view and for an analytical point of view, how do we think about these new developments?
Well, it's certainly something that we're paying very close attention to, and we're doing a lot of work on this, and our money and capital market department and Tobias Adrian are following that very closely. But so one thing I want to say first is there is, in particular, the issue is that I would separate issues with crypto assets versus stable coins. There could be issues, there are all kinds of, we can have an hour-long discussion on crypto assets, but let me leave that aside. I think the issue that is relevant for the IMS, International Monetary System, is probably more with the stable coins. And when we think about the stable coins, there are a lot of interesting parallels with the Eurodollar assets that emerged in the 1960s and then grew to become one of the major type of assets that is traded internationally. And those, and as a point of reference, if you look at the stable coins in circulation, the largest stable coins, Tether and UDC and all of that, and you look at them in relation to the size of the global financial system, and you compare that to where the Eurodollars were in relation to the same, with the same metric, and you ask yourself, are we in 1960, are we in 1970, are we in 1980? We're probably somewhere around 1963, 1964. So very, very early in terms of the overall size of these markets. But that doesn't mean that we shouldn't be vigilant, because they can grow very quickly. Now, why do I say they are a bit like Eurodollars? Because there are ways of trading dollars that are outside, not the physical boundaries of the country, that was what the Eurodollars were, but outside of the physical boundaries of the world, because they are in the virtual world. And they pose the same kind of question in terms of stability of the financial system if they are not fully backed. Right. So you have, if a stable coin is a claim to a dollar that is held in a US financial institution, it can be verified, it can be certified that it's there, it doesn't really create a financial stability risk. It's just another way in which it can be transacted. But if it becomes something that is not fully backed, then it creates the potential for the same thing as the Eurodollars. At some point they were not fully backed, at some point the issue becomes, what is the backstop? And that required the Federal Reserve to come in, and historically the BIS played also a very important role and provide some backstop in the form of swap lines. So the question for the use of dollar stable coins in particular is their rise can increase, that can create financial stability risk, in particular if there are concerns about how well they're backed. Now, legislation in the US is under discussion. There are various bills are being discussed in the Senate and the House. As we understand it, they are at this stage, these bills enforce levels of backing that are, in our view, quite adequate, but we'll have to see how that evolves. The other question is, if these stable coins are out there, they can do, one of the things they can do is they can draw into using those dollar stable coins retail users that would otherwise be transacting in their own local currency. So you could have currency substitution, yes, and that currency substitution can create financial stability risk or risk for monetary policy transmission in those countries That's a second level of risk. And so then the question is on the jurisdictions where this is happening, how do they deal with that? It's a form of dollarization, if you want. And then the third one is, do you have adequate protection in terms of the anonymity of the transaction? So can you do all the anti-money laundering, all the counterfeit, and all of that? So these are, instruments that need to be there. And a number of people have pointed out that, if this generalizes and become a way to evade banking or fat cat regulation, then that, in a sense, is something that could be harmful to many jurisdictions, but including the United States.
Excellent. So let me, and I will, in a little while, we will open up for questions. So please do think about the questions you may want to ask to Pierre-Olivier. But so I would like to go back a little bit to something very interesting also that you showed, which was, in fact, that manufacturing, the share of manufacturing in the economy, in terms of output, had not declined. It was unemployment because of increased productivity. This is something that I don't think people realize, and I think was very interesting that you pointed that out. At the same time, we clearly see that politically, people care a lot, at least in some jurisdictions, about manufacturing, right? So the question is a little bit, why is that? Why do we put this, strong emphasis on the manufacturing sector while, the service sector is developing and it's also creating jobs? And when we talk about all these, all these tariffs, et cetera, obviously they are mostly on manufacturing goods, right? While a lot of international trade now is also taken off in services, right? So why do we have this huge focus on manufacturing, and is it, is it from an economic point of view, is it really warranted, or?
Well, there are many layers in this, so let me mention a few things. So first, one of the things with trade in services is we don't measure as well the bilateral flows in services. Are actually much harder to measure. And we're doing work at the fund to actually construct a database of bilateral trade in services to exactly understand who trades what with whom. And then within services, if you think about services, it's a big category, and we also need to unpack it, whether it's we're talking about tourism, whether we're talking about financial services, whether we're talking about business services. So there are all kinds of categories of trade in services, and not everyone is trading in the same way with other countries. And some countries are actually doing very well by trading in services, whether it's in tourism or financial services or in, some forms of.
Well, the US is exporting a lot of financial services,
exactly.
For example. Yeah.
The second point is more about I think you were going to the political economy. I think there is a sense in which, and I think this is where a lot of my own interpretation of the pushback on globalization and trying to go back to a world in which there is more manufacturing that is done at home. There's often this reference to the good jobs, that somehow manufacturing of the olden days, these were union jobs, you were able to provide for your family maybe with just one wage earner, you were able to have some form of standing in society and maybe lack of uncertainty, and that somehow those jobs have disappeared. Maybe the services jobs are more, gig economy and things that don't provide any guarantees. So I think there is a broader appeal beyond the manufacturing, which is to try to go to something that provides levels of security that maybe are not as present, whether in manufacturing or elsewhere. The third thing is I think there is the issue of, and that's something that I know, Hélène, you and I, we've discussed before, which is the issue of speed. I think what is quite striking, this technological progress that I had on my slide, the transition from agriculture to manufacturing, manufacturing to services, has been going on for decades. It's the nature of technological progress. And by the way, maybe we'll see another disruption with AI coming into services, different types of services that might benefit or might be hurt by AI. But it happens up until now. I'm going to leave AI out. It happens at a relatively gradual pace. Industrial revolutions, yes, they happen, but before the steam engine is adopted and you have a huge share of employment in manufacturing, it takes decades, sometimes even more than that. The production lines for producing cars, etc., again, it takes decades. So these kind of transitions happen, but societies and economic systems have time to adapt to them because they don't happen overnight. The China shock, which is something that has captured the mind of a lot of people, is something that happened in less than 2 decades. It's, you know, China enters the WTO and gets the trading status with the US in 1999-2000. By 2010, most of the effects of the China shock are already there, and you will start having papers that are documenting what's happening. It's a very short amount of time to have a large disruption. Economic systems and, you know, communities are not designed to handle this kind of transitions happening so fast. So the question is not so much trade versus technology, it's the question of the speed. And I think that's something that we have to sort of do a better job in thinking about. It's not enough to say, oh, we can compensate people who are hurt. Economists have this terrible jargon. They say, we can compensate the losers. Yeah, great. Who wants to be labeled a loser? Who wants to be compensated? People want to have decent jobs and they want to have their lives. So, you know, that's already the wrong way to approach the problem. But even if you think about the transfers and all of this, we don't know how to do them. We don't know how to do them very, very well. The macroeconomists have, you know, look at this from 30,000 feet. The microeconomists look at it from the ground and they tell you it's very hard. So we have to do better on this. But we have to think of the speed at which these things are happening, because I think the speed is really what gives rise to enormous amounts of political backlash later on.
Indeed. So a lot of food for thought, because in fact, in economic models, we are not very good at modeling speed. We don't usually do that. Very good. So I think it's probably a good time to open up for questions. So please, I can see already. So if you could just briefly say who you are, and then please do ask questions. Do not comment on. Yes, please.
So right now there is kind of at least around 1 month discrepancy between China and the rest of the world in terms of the tariff negotiation. So I think this creates kind of, you know, pressure to countries that share their export with China. For example, like country in the emerging markets, Southeast Asia, and Brazil, things like that. So my question is that, do you think that this particular 30% tariff will be their benchmark, or at least like the least number that they need to achieve before the US before the term ends? Because after, for example, if you're Vietnam and you was imposed to say 42%, and you basically you can't beat China.
So I'm not sure.
So do you think that this 30% should be kind of, let's say, a benchmark in terms of negotiation? And if, because right now, right, because China get the 30% and the rest of the countries still need to find their numbers in terms of negotiation, do you think that this will become their benchmark?
Yeah, so I mean, first, the IMF, we're not going to be in a position to give advice on what tariff should be. But certainly what we can observe is that, you know, some countries that are facing elevated tariffs right now and are, you know, maybe will be negotiating them down in some part of the bilateral discussions they're having with the US administration. Some of the countries in particular that have been benefiting, I think you mentioned Vietnam, from some of this trade redirection, they may, you know, they may be in a position where that trade redirection may not be functioning, or there might not be a venue for that going forward. That will depend on what's happening. We are seeing, in fact, what I mentioned earlier is we're seeing a surge in exports from China to other Asian countries already. We saw that in the first quarter of the year. The latest trade data from China came out less than a week ago, and we've seen the surge in exports to other Asian economies. Now, that's not giving us enough of a window to know where that is, and as I've mentioned, you know, we're a bit in the fog of war right now because the situation in terms of tariff has not settled down. So I think right now there is uncertainty. The businesses are not going to be able to sort of decide to invest in one place versus the other unless they get some clarity. We are calling for that clarity to be reestablished as quickly as possible. I think there is a question, you know, if we have a configuration of tariffs that are not prohibitive, there will be a question of incidence, which is who bears the cost of the tariffs, whether it's the businesses, whether it's the consumers, where is the incidence going to be. But there will be clarity in terms of the investment decisions, and I think that will already be an improvement compared to the current uncertainty.
Very good. Richard?
I think the previous questioner was asking you to interpret Trump, and that's a mug's game. You don't want to try to do that. But I'd like you to respond, in a sense, to Trump's comment immediately after Liberation Day, so-called, when he reversed field. And he reversed field, he said, the markets were getting a little yippy, right? And we know that the markets were indeed quite disturbed. Are you, as the fund, at all concerned about the risk of a financial crisis that might arise from the kind of disruptions we are now seeing in the world economy?
Yeah, so we've seen volatility. We've seen various measures of stress going up in some of the funding markets. For instance, we've seen some disruption in the U.S. Treasury markets. Various basis spreads and the swap spread have moved up in the immediate days after the announcement, and yet. And now this is partly endogenous because, of course, policy has also adjusted. So I cannot do for you what would have happened if the announcement that remained, we didn't have the pause, for instance, what would have happened in that situation. And yet we were not in a situation that is comparable, for instance, to what was experienced by the markets in March 2020, where there was also disruption in some of the funding markets for treasuries, but that required very substantial intervention by the Federal Reserve with injection of liquidity, with the setting up new facilities, the FEMA facility, setting up activating swap lines, doing all kinds of things. None of this happened this time. The Federal Reserve hasn't done anything. And the stress kind of resorbed itself. As I said, maybe endogenously, policies were adjusted in a way that some of that went away. So when we do our global financial stability assessment, we're looking at the banking sector and we're looking at the non-banks. When we're looking at the banking sector, our sense is that the banks are in a relatively healthy position, whether it's in the US or in other parts of the world. It's not uniform, of course. There are going to be institutions that are maybe more vulnerable than others. But overall, the buffers are relatively strong, and the banking sector is in a relatively good position. So we haven't seen any sign of stress there. There was nothing like what we experienced in 2023, for instance, with the mid-sized regional banks in the U.S. that were under severe stress. The point of concern is more when we look at the non-banks and the point of contact between the non-banks and the banks. So that's something that we are concerned about. Now, the difficulty there is almost by design, is not a bug. It's very hard to know exactly what's going on in non-banks because, well, they are not reporting as banks. They don't have the same reporting requirements. They don't have to disclose as much. So we kind of try to triangulate information. Central banks and regulators are kind of trying to do the same thing. The Bank of England is maybe at the forefront of some of these things, having developed ways of doing forms of stress testing for parts of the non-bank financial institutions that are generating quite a bit of interest for other participants. We at the IMF, we are not sitting on regulatory data. We're not sitting on, we don't have access to the regulators or central bank data. We are relying on publicly available information or commercially available data. So we are doing something that's a little bit at a remove from some of what the regulators can do, but we are trying to do our best. One of the things, as I said, is the point of contact between the banks and the non-banks, where one of the statistics that our colleagues in doing the Global Financial Stability Report have published last month is for US banks, their exposure to private credit represents about 120% of CET1. And so now it's not that we expect that all of a sudden this will be vaporized, but somehow this is something that needs to be monitored carefully. The US banks / private credit connection is probably stronger than in other jurisdictions like the Euro area, where my understanding is that it's not quite at that level, but it's rising rapidly. So this is the kind of things that we're watching. We are not getting a sense that there is an imminent risk. Famous last words.
That was a dangerous thing to say. So I'm told we have time for one more question. Oh, there are two. Okay, so quick, and maybe we take the two together. And
sure.
Yeah.
Fantastic. We've talked a lot about the risks and the dislocations so far of all of the U.S.'s activities. Where are the opportunities? Where do you see which parts of the world, larger economies, regional groups can actually benefit from this, and do you see have the potential to actually come up higher?
Very good. And yes,
Sure,
please.
mine is quite unrelated, but so do you think there's any likelihood that the tariffs might be reversed, and if not entirely, at least to a large extent? And if that was the case, are there any areas in the economy where the damage has been made? And I'm asking this in the context because I was at the IDB meetings last week in Milan, and there was a lot of talk about increasing regional ties with, because this has triggered really like an anti-American sentiment across the world. So yeah, I just really wanted your thoughts on that as well.
Well, I think the two questions are in fact connected because I mean, the trade policy uncertainty, a lot of that originates with U.S. policy right now. I think everyone can agree on that point. And so if you're a business, one way in which you can be totally hedged against that risk is if you have your entire supply chain inside the U.S. or if you have your entire supply chain, including yourself, outside the U.S. That is a situation where you don't face the uncertainty except very indirectly in terms of a macro sense, but not directly in terms of, you know, the stages of production. And so we're going to see some of that, and we're going to see it in the form of, I've mentioned the drive towards deeper regional integration. And so I would expect that we will see a lot of opportunities there in that space. And going forward, whether it's between emerging markets and advanced economies, or between emerging markets themselves. And here there is a broader concern that I have that I think that is very important to keep in mind is also as we have this, you know, we're getting into this world where advanced economies may be putting tariffs, and in particular on emerging market economies. The development model that has been hugely successful is one where we let emerging market economies enter into the global economy, compete there so that they get all the right market pressures to improve their game and learning by doing, improve their productivity, etc., even if they get some level of protection on their home market. The world economy has tolerated infant industry for emerging market economies, and we have success stories on that front. The problem, and there is a problem with that, is when you have a large economy like China that is applying the same kind of policies, but with potentially more market distortions, because this is not entirely a market economy. So with more market distortions, and given its size, larger spillover on the world economy. And so that is the situation that the rest of the world is kind of also dealing with, and we should not forget that. But the problem is, if the advanced economies start responding to this by erecting trade barriers, they are basically closing off this growth avenue for emerging market economies. And what are emerging market economies going to do? They're going to look at this and say, okay, well then we have to do it at home. Then we're pushing them back into an import substitution strategy. That's been a total disaster. So it's certainly, we want to be careful about not sending that message. Emerging market economies need to have a place where they can compete, they can improve their productivity, and they can then, you know, open their economies and also, you know, embrace competition. That is something that has to be preserved going forward, and those economies are going to be doing that, and there's a lot of room for this. You look at countries like India, you look at many of the emerging market economies, there's a lot of room for improvement in that space, and that's where I think we are going to see some gains going forward.
Well, thank you very much, Pierre-Olivier. That was really fantastic, and I think Sergei will now...
Even to try to summarize this very rich discussion, thank you very much for also giving some light in the end of the tunnel in the very end. And thank you very much for not showing the fiscal policy slide. I'm sure that would be even more depressing with debt sustainability and fiscal deficit, which in the US is not coming down. So I think that saved us some depression as well. I would like to advertise the future events of Wheeler Institute. As amazing this this talk was. We have more events in this academic years. This academic year is coming to an end. We have Colombia's President Alvaro Uribe coming to speak on 29th of May. We have the founders of the Institute, Maureen and Tony Wheeler, who also happen to be founders of Lonely Planet, to come and talk about their life and their life trajectory. And finally, we have Daron Acemoglu coming. The Wheelers are coming on June 9th, and Daron Acemoglu is coming June 19th, talking about remaking liberalism. So, full program ahead. Please sign up. And once again, thank you so much, Pierre-Olivier, for this very, very rich and insightful conversation. Thank you.